I want to show you some slides on the European markets I just looked at, compiled a little bit. First of all, when you talk about residential, it's always a talk about demographics, but even in countries where you have declining demographics, like a lot of the CEE countries, Germany, Italy, Portugal, whatever, it comes down to location where you really have to figure that out. At the end, demographics is only one part of the whole equation. It might give you a first impression, but at the end you have to always remember it's a local market. Residential is very local, so the question is what is actually happening within the countries. And if you look at that urbanization, that the people moving to the agglomerations where you have jobs, where you have employment possibilities, is increasing. So you still have the people migrating to cities. You also have the demand in the cities. And that's what drives especially the residential markets in the urban areas. So you have to be aware of these, that countries with a declining population offer still opportunities because the population is moving from one place to the other, is concentrating in different places, and there you still have the demand side. When talking about residential, a lot of talk is about house prices. And if you look at the house prices in the Eurozone, that's what I've done here is, I named it back where we started. So we were actually there where we started before the crisis broke out. So at the end, what the fuss about house prices? Because in the Eurozone we are more or less on the flat line what house prices are going. But that's only part of the picture. Because if you're looking a little more in detail, you see that you have a lot of different facets in the market. You have the markets with rising house prices, might it be countries like Switzerland, Germany, Austria, Norway, to a certain extent Sweden, Finland. On the other hand, you have the markets with declining house prices, especially countries like Spain, UK, Ireland, or even we are now here in the Netherlands. Although the Netherlands is one of the markets where you still see prices in a phase of correction. So it comes down not only to look at when it then comes down to the European Central Bank, they have the problem, they're responsible for the whole Eurozone, and in the Eurozone the house prices are flat. So the problem then comes down that the Eurozone as a whole might not be that homogeneous as a market as we thought, and even Europe, because some of the countries I mentioned already are not in the Eurozone, and they have some other issues like currency, market access, and also product availability. When you look at the supply side, and that's what I showed you here with the bars showing the stock, the housing stock in the different countries, and the triangles showing the red triangle, the completions as percentage of stock in the past 3 years. The green triangle shows you the completions in the coming 3 years. And what you see here is that in most markets we still have a correction taking place. Completions are going down. There are only a couple of markets to the far left, meaning Germany, Switzerland, Finland and Norway, where we actually see completions are rising. In Germany, there's a lot of fear now that we might run into trouble again, but if you look at that, we have completions on a scale of 0.6% of stock. That's not really anything risky at the moment. You see Norway, Finland, the Nordic countries where you still have a lot of urbanization taking place, especially in Finland you see a lot of north-south movements taking place. And Switzerland, interesting market from that point of view, but given that the legal requirements, institutional framework is as it is, as an international investor, you will have to find some really tricky structures with a good lawyer to be able to invest into the rental market in Switzerland. On the other hand, you have markets like Spain and Ireland. You had a lot of oversupply in the years before the crisis or just after the crisis, and therefore construction is still going down. But I personally believe that there are opportunities arising in these markets as we see some structural changes going on. When talking about residential market and residential investments, the owner-occupier rate is one of the things as an institutional investor that gives you an indication of the opportunity that is in the market. And a lot of markets where we see currently initiatives, public initiatives and also some other interests, it's like the UK, like Ireland, possibly also like Denmark, they had relatively high owner-occupier rates in the past. And the question now is, what's happening again? What I plotted here is how the owner-occupier rate influences total return volatility and total return overall. And that's just because of the alternative use. When you value your properties, the price developments in the owner-occupier sector filter through to the rental market, because as the valuation has to be taking place on the best alternative use, or the price depending on the alternative you're using, so the prices in the owner-occupier sector filter through to the rental market, and the opposite is also taking place in countries like the Netherlands. You see it currently. But the owner-occupier rate also gives you a little bit of an indication what's currently on in the market. You have the high rental markets on the other side, like Germany, also Austria to a certain extent, Denmark, Sweden, where you have high rental markets or high proportion of rental, private and social rental in the markets. And on the other end, you have markets like the UK, where you have a little bit of a rental market, a private rental market, a much higher social rental market, but you now have government initiatives trying to promote the rental sector. You had Denmark as a country where you have a declining rental sector for the years. It still have a decent rental sector, but now, given that they had problems in the private owner-occupier market, a lot of owner-occupier stock was converted to rental and put on the market. You have Ireland as a market where owner occupancy is the dominant tenure form actually. But when you look at the Irish market in the last, let's say, 12 to 18 months, it's quite an interesting change taking place over there. You've seen a rental market emerging. And also I would say, possibly, if you look at the overall of Europe, you had increasing owner occupancy rates across nearly all European countries after World War II. If you look at the last 10 years, owner occupancy rates remained more or less flat, and possibly we are now at a turning point that rental might be a more acceptable tenure for a lot of households in the future, because simply given the change in the financing, on the financing side, the change on the regulatory side, possibly we see a return of a rental market in some countries. Ireland might be one of the examples. The UK is one of the markets where there's a lot of government support for it. Possibly also Spain, because they realized that the obsession with owner occupancy can be a lot of risk. So the rental market might be returning in the next 10 to 20 years. But the question now for the institutional investor then is, where do you find the stock? How is availability of stock? And that is the crucial question in the years to come. But I would definitely say there is a point now where you really can build a pan-European platform in rented residential that you might not have been able to build about 10 to 15 years ago. So that might be the starting point overall. And if you look at what the return side is, multifamily housing still remains attractive if you look at the yield ranges compared to government bonds, because seeing government bond yields, they are definitely in a lot of countries on historical low levels, especially if you look at Germany or some other of these core European countries. But still, even in some other countries, there is a decent return that can be generated from multifamily housing. So it is attractive, and it's no wonder if you look at like for instance the levels in Denmark, that a lot of international capital is now pouring into Denmark for residential investments, because you have a high demand side in the Copenhagen area, you have product availability, and you still get a decent return compared to what you can get in some other European markets.